are 3 sessions, video recordings from those sessions, very similar to what we're doing tonight, of a dear friend of ours, who every time he comes to Madrid with enough time, he makes a stop and shares with us the knowledge that he has gained in his long and very successful career as a professional portfolio manager, investor, if you will. For those of you who don't know Pavel Begun, let me give you some background. First of all, Pavel Begun is co-founder of 3G Capital and has over 20 years of professional experience investing in companies. Before co-founding 3G Capital, he worked as a research analyst for Fiduciary Asset Management and also for AG Edwards & Sons. Pavel Begun is how do you pronounce your last name?
Begun.
Begun.
Yeah.
Oh, well.
But it doesn't matter, like I'm not offended, so.
No, Pavel Begun is a chartered financial analyst and a member of the Toronto Society of Financial Analysts. He graduated with honors from the University of Chicago with an MBA in accounting and finance. Pavel, welcome back to Value School.
Thank you.
Thank you very much.
It's a pleasure to be here.
It's always a pleasure to have you here. And he has prepared some slides. He has chosen a very interesting topic, and I'll give you, he'll have 30, 45 minutes to present his ideas, and then we'll open up for questions from the live audience here and from those of you watching from home. So the floor is yours, Pavel.
All right. So tonight, I'm going to talk about value investing in a global setting. And then in the course of my talk, I will first discuss the theory behind the concept. And then later on, I'm going to use a specific example to see how we can apply value investing in a global setting based on a real life example. So some disclosures here. First off, some background information. 3G Capital is a private investment partnership that invests in undervalued businesses around the world. Our investment universe includes frontier, emerging, and developed markets. Our investment strategy calls for investing at single-digit multiples in a small collection of industry-leading businesses. Basically, we target the 3Gs: a good business, good management, at a good price. We have been in business since 2004, and in the course of our existence, we produced a track record of significant outperformance versus our benchmark. So here you can see that since our global strategy inception, we generated a return net of fees of 13% versus 8% for the benchmark.
That's quite impressive.
So with background out of the way, let's delve into the topic. So as I just told you, our investment universe includes frontier, emerging, and developed markets. And so we're global value specialists. So why global value? How do you apply global value? So from a geographic perspective, there are a couple of ways you can apply the concept of global investing. You can either focus on applying value investing to developed markets, which is what most managers do. And the reasoning behind this is because they say, look, in the developed markets, the rules of the game are well established. Therefore, the playing field is level, so you can invest and win. Now, most people deliberately avoid the frontier and emerging markets, and the argument goes like this. So those markets have regulatory and governance standards that are much weaker than those in the developed markets. Therefore, the game is rigged, so you cannot play and win. So this is what conventional wisdom says. So is it really the case or not? So let's just see how that aligns with reality. So before we get into the analysis, I'd like to share with you a couple anecdotes that are going to be relevant to getting perspective as to how things work in a global equity setting with respect to both developed and frontier and emerging markets. And the first anecdote actually has nothing to do with investing, but it has to do with an experience of Hans Rosling, who is the author of book Factfulness. So when he was a fourth year medical student in Sweden, he got a chance to go visit India and spend some time at a medical school in India. So he talks about his experience, and he talks about this case of him walking into a room full of fourth-year students in India, and you have this professor who is showing the students a bunch of images, and he said, look, identify which images contain kidney cancer. And Hans, sees kidney cancer, identifies it, but he doesn't want to show off, so he says nothing, sits back. He is sure that, nobody's going to say nothing, and then the floor is going to be his. All of a sudden, he sees all those hands go up. So all those Indian students, they basically correctly identify kidney cancer. They explain very clearly as to why they identified cancer as kidney cancer, and they answer the questions that only chief physicians would know. So at that point, Hans thinks, oh, you know what? I must be in the wrong room. Those must be specialists, not fourth-year students. But when he walks out of the room, he talks to those people. He talks to the students. He's like, oh, you know what? I actually wanted to go into the fourth student room, and I ended up in the specialist room. And they shock him because they said, no, we're fourth-year students. And he doesn't understand it. He's like, how can that be? Those people, they have a cast mark on the foreheads. They live where those exotic palm trees grow. And how come they know more than me? And I'm from Sweden. I should know better. And of course, once he started hanging out with those students, he just realized that their book was twice as thick as his, and they read it 3 times as many times. So that's, yes.
Give me, would you recommend Factfulness, even though it is not a book about investing or finances? Why would you recommend it if you would?
Well, I would recommend it because I think as an investor, you'd be very well advised to read it, because it's a book that teaches you to make your conclusions based on facts rather than emotions.
Okay.
And when it comes to investing, the number one thing that you should do as an investor is to separate emotions from the facts. And you should make your conclusions specifically based on facts and not emotions and not conventional knowledge.
Yeah, I think he was very insistent on avoiding preconceived notions and preconceived ideas about how the world works and what the world is really like, especially as regards less developed countries.
Yes. And that's why, I thought it's an interesting anecdote that really sets up the conversation as to how you should be looking at emerging and frontier markets compared to the developed markets.
Brilliant.
And then the next anecdote is basically a nugget of conventional wisdom. So at some point in the past, I had a conversation with a money manager who is based in the developed market, never set a foot in the emerging markets, unlike Hans Rosling, never had any firsthand experience of analyzing an emerging market business. But he was very confident in saying that, hey, look, I can see how you can underwrite business quality and invest and make money using a repeatable process in North America, Germany, Austria, Italy, whatever. But to do so in places like Brazil or Thailand is simply impossible. So basically, he said, cannot be done. Is it really the case or not? Well, maybe, but let's look at the data. And I think it's very interesting to look at history. So you go back 100 years, and what you're going to see is that the most established and the most advanced market in the world, which is the United States of America, well, that used to be a frontier market. And then later on, it was an emerging market. And then finally, it matured to become a developed market. So if you look at income per capita in the US, you can see that up until probably mid to late 40s, the US used to be a frontier market. It used to be an emerging market from probably mid to late 40s to mid to late 80s. And past that point, it has matured into a developed market. So I think what we need to look at the data and see whether it has become easier or harder to generate returns in excess of passive strategies as the US market progressed in terms of its maturity. And here's some data. So what it is here, I calculated the valuation disparity over the past century for the U.S. stock market. And essentially what it is, this is the ratio of the most expensive to the cheapest stock in the market. So essentially, it's a measure of how many undervalued ideas you can see in the marketplace. So the higher the ratio, the more undervalued ideas. Mm-hmm. And if you look at the frontier stage period in the U.S. market, so basically before the mid-40s, it was 4. Then it got cut in half once the U.S. got into the emerging market stage. That was like between mid-40s and the 80s. And then finally, once the U.S. market entered the developed market phase, which is basically past mid to late 80s, that ratio has dropped even further to below 1. Mm-hmm. So it appears that it actually has become more difficult rather than easier to find undervalued ideas in the U.S. to generate excess returns in excess of passive strategies. Mm-hmm. And that, yeah.
Would you say that this is due to the market becoming more efficient, which is a good thing at first, you know?
It is a good thing for sure, unless you're an active investor.
Okay.
If you're an active investor, that's not a good thing, right? If you're an index fund investor, probably a good thing.
Okay.
But as an active investor, you thrive on inefficiency.
Okay. You want to exploit the inefficiency.
Right.
Okay. Okay.
And the quantitative data that you see here, that is not inconsistent with anecdotal evidence. So here, you can explore the 3 stages of the U.S. market going back a century. So you had this frontier market stage prior to 1940s, and that is what I call the Benjamin Graham period, right? So this is when he devised this method of making money by buying companies at less than their net working capital alone. So that was very mechanical. Anyone could do it, and it was a repeatable process which anyone could use to generate return in excess of passive strategies. So that was very easy. Mm-hmm. And it was a frontier market. Mm-hmm. And then if you look at the emerging market stage, which is again between like mid-40s and mid-80s, well, those net working capital deals, they dried up. So they were no longer available. So it has become somewhat harder. But you could still find those kind of basic high quality businesses selling at low multiples of earnings. So it has become harder, but it was still very doable. And like that is the period that I call the Buffett and Munger period, because that's what they started doing, as opposed to buying net working capital deals. Like Graham, they were buying basic high quality businesses at low multiples. And of course, once you get to the developed market state, which is post mid to late 80s, what you see is that obviously you don't see any net working capital deals no more, but you also do not see that many basic high quality businesses selling at a low multiple. So the number of those ideas have shrunk or outright disappeared. So now it has become very hard to identify attractive investment opportunities that help you generate returns in excess of passive strategies. Mm-hmm. So what are we going to call this period? I'd probably call it the index fund period.
Yeah. Yeah.
So it turns out, looking at the data, is that, it has become, again, harder to generate returns now that the market is more efficient. Mm-hmm. And so it follows that for a knowledgeable and rational investor who is armed with the right strategic toolkit, such as value investing, it is actually easier to identify profitable investment opportunities in frontier and emerging markets in order to generate excess returns versus passive strategies. So I think the reasons for that is because you simply have fewer intelligent competitors who are armed with the right investment approach, which value investing is, who go over the data set in those emerging and frontier markets. Mm-hmm. And there are multiple reasons for it as well. Just to set up to be able to invest in an emerging or a frontier market, you have to set up infrastructure that could be costly, time intensive. You also have issues of market depth. A lot of times there is not enough market depth. Knowledge acquisition, also costly, also, very capital intensive. You also have issues with respect to investment mandates. A lot of those managers, they have very rigid investment mandates, so that do not allow them to invest in frontier and emerging markets. And finally, you just have a my side bias, because if it's somewhere else where people have a cast mark on their forehead, well, you just feel like it's a weird place. You just never assume that they have a book that's twice as thick as yours and they read it 3 times as many times.
Can we go back to the previous slide? And would you say that maybe today, practicing value investing the way Ben Graham did, the net cigar butt approach, I wouldn't say, but perhaps, would you say that it's impossible, or it's just hard enough that it's really perhaps not worth it? Whereas in the other markets that you're now explaining and discussing, now it's still possible to practice value investing the way Ben Graham did and still make good investments.
Look, I think if you look at net working capital deals in the US, I think you're going to be hard pressed to find enough to make it work.
Okay.
Because you would need to diversify quite a bit. You'd need to find dozens of them, if not hundreds. Okay. And they're just they simply do not exist in the US.
All right.
But in those emerging markets, frontier markets, they still do.
Okay. Good.
So, couple of things. Just I think it's good to compare the emerging and frontier markets of today to the emerging and frontier markets of the past, because obviously they're very similar in many ways, but there are some differences. So I think a couple of things that are notable that I'd like to highlight. Number one, there's a difference in terms of market structure. So what I mean by that is the fact that in those emerging and frontier markets, they're inherently smaller. Then a lot of times the governments in those places, they pursue pro-consolidation policies. And what you also have is management talent that is very unevenly spread. So managers who are in those markets, some of them are brilliant and some of them just have no knowledge, because in the West, it's a lot more evenly spread. And I think the outcome of that market structure is that a lot of those markets, they end up in this kind of monopolistic or oligopolistic structure. And then they also end up in the structure much faster compared to what happened in the West. And as a result of that, a lot of those emerging market and frontier businesses, because they get to this monopolistic position faster, they have returns on capital that are better, and they grow at rates that are much faster. So it just, they end up having better economics at times. And the second thing that is notable is that the policymakers in those countries, they have the benefit of hindsight. So they don't need to invent anything and implement. They basically can look at what worked in the past, what gave rise to prosperity in the frontier markets of the past, and then they can basically take those things, copy them, and implement them. And as a result, that progression from frontier to emerging to developed in those markets today, it happens at a much faster pace. And you talk in management quality, governance, regulatory matters, transparency, all of that is improving much, much faster. And ironically, what I've seen in some of those markets is that their disclosure standards or management quality is going to be, or capital allocation policies might at times be even better than those that we see in the West.
Really? How come?
Well, I think they've been able to sort of, as opposed to growing by iteration, which is what happened here, they already noticed what the West did. So when they were building the business, they already did it with the benefit of hindsight. They said, let's just copy and improve, as opposed to, well, we'll just be inventing things on the fly.
So they adopted the best practices right away.
Right away, and they basically made them better. Because again, they can put them together in a way that is more rational, because they're doing it from the ground up. They're not building legacy infrastructure on top of legacy infrastructure. So where does it leave us as value investors? Well, we have been in business since 2004. And up until about 2007, 2008, we've been exclusively focused on the developed markets. And then as we examined various markets around the world, we came to the conclusion that we have to go global because the number of attractive combinations of price and quality was just so much larger if you were looking at the global markets as opposed to just looking at the developed markets. And I think one thing that is telling is that if you look at the number of publicly traded entities in the world as a whole, it's 60,000. But US plus Europe, it's only 10,000. So it's a much, much bigger pool. Mm-hmm. So here you can see the outcome. So when we invested in the developed markets, our returns were about 6.7% per annum. But once we went global, we produced a track record of returns being about 13% net of fees. So wow. A big advantage.
Yes.
Now, even though our returns have gotten better, it's not like we've gotten any smarter. It was not the reason. The reason is that we simply went to the markets where the competition for profitable ideas was much less intense. So these markets basically offer profitable investment opportunities that do not require high IQ to identify. Mm-hmm. 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 So here, let's talk about a practical angle to the whole theoretical concept of applying value investing to emerging and frontier markets. So here, I'd like to talk to you about an idea that we invested in about a year ago, last September. So the company I'd like to talk to you about is called Genoma Lab International. I think that means DNA in Spanish, from what I understand.
Genome, right?
Yeah. So that company is based in Mexico City, Mexico. And they're the leading provider in Latin America of personal care products and OTC pharmaceutical products. Anytime we look at a business, we always start with a competitive advantage. This is the number one thing that we want to see. And with Genoma Lab, that advantage is their market leadership. If you're to look at the brands that Genoma provides to the market, they're number one, number two, or number three in their respective market segments. So their competitive position is actually protected by two things mainly. Number one, it's the brand power, and number two is the distribution power. So with respect to brand power, it is consistently reinforced across both traditional and digital media. Genoma Lab is number one in Latin America when it comes to TV advertising. They're number one multimedia content producer, and they're number one in terms of digital awareness as well. Mm-hmm. When it comes to the distribution power, they have an unparalleled network of about 500,000 points of sales in Latin America. They're number one when it comes to the size and the reach of the network. And most of those points of sales are served on a direct basis. So it is no surprise that with advantages like that, the business is very profitable. They have operating margins in excess of 20%. They generate returns on tangible book of over 30% while employing minimal debt, as evidenced by their debt rating of AA+. Now, of course, you always have to examine that second element of business quality, which is management, mm-hmm. the second G that I talked about in the very first slide. And I would say that management quality at Genoma Lab is a match for business quality. They have excellent operational skill. If you look at their track record, you see that they came on board in 2015. At that point, business was break even. And since that time, they have grown earnings to 4 billion pesos. Wow. So it's a good accomplishment. And they did it by basically focusing on the biggest and the most profitable brands, by constantly improving supply chain, and by making sure that they always focus on cutting the non-essential cost. In addition to being excellent operators, they're also capable capital allocators. Again, if you look at their track record as to what they do with the free cash flow that the business generates, they send most of it back to the shareholders in the form of dividends and share repurchases.
Mm-hmm.
And of course, the third element of the investment equation for us is always the price. No matter how much we love a business, we always demand a highly attractive price, and the Hinomala was no exception. So in our case, the price that we paid at purchase, which was last September, was basically 5.5 times forward earnings and a dividend yield of 6.5%. Mm-hmm. And was not hard to see that the business was significantly undervalued because the company's global peers, they would sell for between 16 times and 22 times earnings.
Mm-hmm.
So, and if you look at what happened past the purchase, the stock price has gone up nearly 100%, but still remains undervalued. We're still shareholders because the company's selling for just over 10 times earnings as profitability improved. So we're happy to remain shareholders and just wait for further upside. So that concludes the presentation part. So now happy to take whatever questions you might have.
Sure. Let's wait for Thelina to come back and we'll hand you a microphone. I have a question for you. Let's discuss, if you don't mind, the less positive sides of investing in these markets. And by this, I mean, I'm sure it must be costly maybe to build a significant position in some investments because of the characteristics of the market, the liquidity of the stocks, perhaps that the manager incurs more substantially higher brokerage fees, and maybe even the whole ride can be more bumpy for the investor. I don't know, is volatility increased when you develop in these countries?
Well, the volatility is definitely going to be higher, and I think you referred to that point because you said, well, they're probably more I guess, less efficient compared to the U.S. market. And of course, lack of efficiency implies higher volatility. So definitely will be a bumpier ride. So I think one has to be able to have the time to play out the hand. So
it's even a longer long-term investment.
Right. I'd say, probably 3 to 5 years. And I think you also have to be more careful about the valuation as well, because the market is less efficient, which means that it will always go a lot lower than you think it can. So,
all right. How do you communicate those variables to your base of investors, to your investor base? Because especially when you made the transition, because that's a significant shift in focus.
Well, I did exactly what I outlined in the presentation. It was basically showing people the numbers, saying, look, in a developed market, I can buy a business for 13 times and that business doesn't grow much and it's maybe worth 17 times. So that upside is limited and it doesn't grow much. Or I can go buy Hinomala and I can buy it at a huge discount, right? Like it's 5.5 times earnings and probably worth 15 to 20. So as an investor, what would you rather have? Of course, you have to explain that we're going to be allocating money within the portfolio differently. I don't think we're ever going to be 100% invested in China or Turkey. So I think you have to diversify a lot more. Number one, because there is the geopolitical risk I mentioned. You also have things of that sort. And you want to monitor the cross correlations within the portfolio as well to make sure you're not overly exposed to any one market. But I think as long as you follow those rules, then you're going to be on track to generate good returns, good excess returns versus passive strategies without taking on too much risk.
I was going to ask you precisely about China. So you don't rule out China as a destination?
No, we don't rule out China at all. No. Again, like I said, China is never going to be 100%, it's never going to be 50%, but it's going to be a portion of the portfolio. We'll be sure to diversify within our China basket as well, as to not to overweight too much any specific name, but we don't rule China at all.
Would you say that investors that do are exaggerating some risks, or are you seeing things that they are not seeing? What's the reason why you consider China as a good place to look for investments?
Well, I think you can start looking at prices, and I think once you start looking at prices, you start thinking, well, you know what? Look at the upside and the downside. I can give you an example. So we own this one company in China, and it has a dividend yield of 25%.
Wow.
They've been paying the dividend for we own it for 2 years. They've been paying the dividend for 2 years. So in 2 years, we de-risked it by half, right? 2 more years, we took all of our money off the table, right? And then you just own the stock for free. So what's the risk here? And I know people are going to be saying, well, what about China risk? But I would point to a company like Apple, right? Apple derives 20 to 25% of its sales from China. So those same people who are going to tell you that they're afraid of China and they're not invested in Chinese equities, those same people who are afraid of Chinese exposure, supposedly, they will be buying Apple, but they will not be getting a 23% dividend yield, right?
Of course not.
They'll be paying 30 plus multiple wise, right? And for a company that doesn't really grow. So I think it goes back to saying, let's look at the facts rather than sort of looking at the emotional side of things.
Would you say that it is harder for you to conduct your due diligence in these countries than it is in more efficient Western markets, so to speak, because they may be less transparent or less willing to divulge information openly to a Western investor?
Definitely, data collection in those markets is more time-consuming and more expensive, which is a good thing because that scares out most other people, so I have less competition.
All right.
So for those people who are willing to commit the time and go the extra mile, then they're going to have a much better advantage.
So I guess you're working with translators, experts in financial regulation in the markets that you're interested in. I mean, you must have a team of people who know the things that you don't know about that precise market.
Right, and you have to have a team of sorts. It's not a formal team. It's basically what we call an intelligence gathering network.
All right.
So people who kind of just there on the ground, they're not necessarily employed by us, but those are the people we develop relationships with. And that could be either vendors or customers of those businesses, could be competitors, service providers. I don't know, sometimes we get to talk to perhaps like a Deloitte and Touche auditor, right, who audits certain businesses in China. So they'd be able to help us develop a view. So industry insiders, definitely, you can't really do it from your desktop in Toronto. So you have to know what the story is in reality. But again, like I said, like this is difficult to do, but if you're willing to commit resources to it and commit the time, then you're going to be so much farther ahead compared to the competitors who just might not be willing to do it.
How often do you travel to these countries, let's say Mexico or maybe China? Would you say that gives you an edge or a particular advantage to be there on site, meeting the managers or exploring the facilities?
I wouldn't say it gives you a huge advantage. It's good to know. It kind of sets the tone, but I'd say that's just part of the process. So I don't think that's like 90% of it. Maybe it's 10% of it. So it's the whole picture. So you have to have your intelligence gathering network. The site visit obviously helps, but again, that would not be worth as much without all the other things that we have in place to analyze those businesses.
Would you consider becoming sort of activist investor? I mean, like saying that you like the business, but you don't think it's being managed quite up to standards, and you would say, okay, we will invest, but you need to let us for some time help you streamline operations and becoming part of the management team?
Well, we never buy a business to specifically get involved in kind of just righting the ship. I think our strategy is to be able to invest with good managers who don't really need our guidance as to how to do things. But sometimes, you get on board and you think they're good, and you know what? It turns out that you made a mistake. We're all human, so we do make mistakes. Well, then sometimes, which that's not the preference, but you kind of have to roll up your sleeves and get involved. That happened a couple of times. Sometimes you have to enact management change. So that does happen. So again, like, we don't seek out those battles, but if we have to do it, we will do it.
Okay, good.
And we've done it quite successfully in the past.
You have?
Yeah.
All right. And what was the experience? I mean, were they open to suggestions and to your intervention, or?
Well, 90% of all cases, they were not.
They were not. 90.
They were not.
Wow.
90%.
So
like, what I realize is that people are just comfortable being in their position, and they don't really want to change. So you kind of have to force it. So sometimes, like, you have to force it with a bit more force, so to speak. But at the end of the day, there is no way around it, right? So. But yeah, for people to just say yes, of course, tell me what to do and I'll do it. I don't think I encountered that ever. There's always a bit of a battle.
Well, it makes sense. That's to be expected. All right, let's open up the floor for questions. Who would like to ask the first question to Pavel? Raise your hand. And you? Okay, go ahead. I'll ask you please to speak out loud so that maybe my microphone can pick it up, and people watching at home can hear you. Thank you.
Thank you so much for the talk. It's very interesting. Actually, it seems that your strategy is more based on the geography of the country and the economy, of how this economy is evolving. But would you define that like that up to bottom approach, or is more about the strategy of the company and how the company you think is going to be managed in that economy? I mean, because in that countries, it depends that the regulation is going to be it could be a really problem for you or not.
Well, that's.
Would you do me a favor? Rephrase the question so that the microphone picks it up.
Okay. So basically, the question is: are we bottom-up investors who are specifically focusing on the economics of the business in a given market, or are we looking at the country first and kind of making a judgment about the country and then maybe buying a business to ride the wave that the country is generating? Would that be the right way to phrase it?
Yeah. Okay.
I can tell you that we are absolutely bottoms up investor. We don't really go into a country saying, well, this is a great country and let's find some businesses there. We basically go around the world and we find a business that we like. And then if we like it, then we're going to look at the country, and then we're going to try to see what can happen to the business within the context of that country. And sometimes you're going to say, well, you know what, I don't want to get involved in the business because that country is just not in the right shape. Or perhaps sometimes you're going to say, you know what, like, it really, for this specific business, doesn't really matter what the economy does or what the country does. You'll still make good money because the business should perform despite all the developments. And just to give a specific example, we can look at Argentina. So Hinoma Lab has a business in Argentina. So you would think that because Argentina went through so much trouble, it's going to be a huge issue for the company. But obviously, when we invested in Hinoma Lab, we considered that risk dimension. And the risk dimension in Argentina would be FX depreciation. That's a risk, right? Or economy being volatile. That's a risk. So we had to consider those. And what we concluded is that for Hinoma Lab, those were not the risks. And here's why. So let's tackle FX risk first. So for Hinoma Lab, they sell a product that is essential and also low ticket in nature. So if there is ever depreciation in any of their markets, and we can talk specifically about Argentina here, they have absolutely no problem raising the price that more than offsets any FX depreciation. In fact, for Argentina, they would always raise prices by a higher amount than the currency depreciation, thereby actually improving the profitability for the Argentinian business. And again, ironically, as a result of that, their Argentinian business is the most profitable business for Hinomalab, which again, contrary to the conventional wisdom, because Argentina has been a basket case for so long. We also had another investment in the past in Argentina. And again, we've owned it for 5 years, and just a know-nothing investor would say, oh, you know what, Argentina 2019 through 2024, terrible, terrible, terrible. How did you do? And we actually made 3 times our money in that investment in US dollars.
Wow.
And why? Because as we looked into the business, we again concluded, because there was no FX risk, because effectively the revenues for the company were based, dollar-based. The costs were local. So we concluded that if there is currency depreciation, that's actually going to increase the profitability, not decrease it. So economy-wise, again, like that business had a degree of stability versus slow in economy. So that we concluded that was not an issue as well. And despite the fact that you've been then in that economy that was doing absolutely terribly, then you still generated very, very good return. And this is because we're stuck with the right business. If we bought, let's say, utility in Argentina, like we wouldn't have done as well, because with a utility, you cannot raise those prices at all. And anytime there's economic turmoil, that hits you. But we try to stick with businesses where you have this implicit hedge within the business against FX depreciation and against economic volatility.
Very good. Good. Selina, may we have a microphone for questions? Who would like to ask the next question here? First row. Okay.
Pavel, great presentation as always. I'd like to understand if, when talking to the management people, do you research or do you care if the management has like a great focus on increasing value for customers and how they treat their people, their employees? Do you care about that? And second question is, I'd like to understand, because your portfolio is pretty much is very concentrated.
Right.
Do you let your winners run? So imagine Hinomalab reaches 15 times, 20 times. Would you sell? Would you stick to that position?
Okay, so I'll tackle the second question first.
Yeah.
If this is not confusing enough. So when it comes to letting the winners run, the question is, it depends. And it depends on the characteristics of the business in question. Hinomalab is not a high growth business. So the business that grows at the intrinsic value may be at a 5% rate. So if it gets to 20 times, I would conclude that at this point, if you stick with it, assuming 20 times is the fair multiple, all you're going to get is 5% return. So to us, 5% return, little skinny. So we would probably sell. Now, we own another company called Kaspi, which is a super app out of Kazakhstan, which I presented at Value Spain a couple of years ago. And with that company, they can actually compound intrinsic value growth at probably a 20 to 30% pace. So with this business, even if like we bought it 5 times, you get to 15 times, like we'd still stick with it, because we'd say, look, they grow those earnings 20 to 30% a year. So even if the multiple does not change, you're still compounding at a very good rate. So then getting back to question number 1, management. So obviously, like if you look at management, there is a spectrum of quality from here to here, right? So if the management is somewhere here and the stock price is very cheap and the business is good, like we still invest. But of course, ideally, which hardly ever happens, but sometimes happens, you want to find a management team that's up here. and of course, we're more than willing to pay up for those great managers. Because I observed, especially in those emerging and frontier markets, how much the value of those businesses is dependent on management. Like for a business, like, I don't know, take Procter & Gamble in the US. That management team is not going to matter as much. It's a slow growth, stable business. You're just not going to invent too much. But if you look at some kind of like nascent business, again, I refer to Kaspi in Kazakhstan, that is basically growing from the ground up. A business like that is really dependent on what management does. So in businesses like that, you really should seek out the best management team, and you should make sure to pay up for those if you have to. And I think you mentioned, how much they care about the customers. So I can give you a very good example, again, Kaspi, just to be specific. So when it comes to Kaspi, how the company developed their strategy is by looking at companies such as Apple, Google, etc. And they said, what is it that those companies have in common? And what they discovered is that all of those top tech companies in the US share the high NPS score, Net Promoter Score, which is a measure of how much your customers love you or hate you. And if you look at Apple, Google, their NPS score is going to be in the 75 to 80 range, right? Normally, if you're like in the 25 to 50 range, this is considered excellent. So if you're like 75, this is like off the charts. And so with Kaspi, management said, like, we're specifically going to create products that have NPS score that is comparable with Apple and Google. So with Kaspi, their NPS score is actually now 80. So they actually like even better than Apple. So, and when they go to market with product, they don't have any targets with respect to profitability or sales. Their only target is NPS score. And the entire product team is including like lawyers and accountants. They're all compensated based on achieving that NPS score. And I think their logic is this: if you create a product that consumers love, eventually it's going to be profitable. If you create that value for the consumer, you are going to get paid. So when I saw that management team, I said, you know what, like, those guys are very good. But I also saw something else. I saw the fact that they were willing to give up half their profit to get rid of products that did not have the NPS score within their target range. Mm-hmm. Again, this is very commendable, because most people would have a hard time saying, look, I have a product that's half my profits. Like, am I willing to just cut it? And they said, you know what, we are going to go ahead and do it, because even though it makes us money in the short term, long term is going to corrupt the culture. We cannot let it happen. So you see guys like that, you know what, like, it's they're solid. And like, you look at, obviously, like, you can talk to them, but I kind of don't mind talking to them, but I like looking at track records more, because it's what you do that counts, not what you say. And again, like, go back to Kaspi. So they were in Kazakhstan, and Alibaba was number one e-commerce player in Kazakhstan back in 13 or 14. And of course, Alibaba is a very formidable competitor. And then Kaspi goes into the e-commerce market. And guess what? Within 3 years, they're number one. They knocked Alibaba off the pedestal. Then I think 18, 19, Kaspi says, you know what, would like to get into payments. And at that time, Visa and MasterCard, which are phenomenal businesses, right? They had 80% market share in Kazakhstan. Within 18 months of Kaspi getting into payments, they were the number one player with 80% market share. And they relegated both Visa and MasterCard to like distant second and third. So when you see management teams like that, they are armed with the right approach towards creating customer value. You just know this is an excellent management team. So I don't see a lot of teams like that. So again, like, I'd be hard pressed to find a team like that in the developed markets, let alone frontier and emerging markets.
Absolutely.
Excellent.
Next question. All right, so I have another question for you, Pavel. Are there any regions or countries that you specifically avoid because, I don't know, geopolitical risks, or that at present you would rather stay away from?
Well, I mean, there are certain markets you cannot invest in because they're sanctioned, right? So, you have to avoid those. Outside of those markets, I would say that, like, I'd be open to invest in any market. However, two things. Number one, you have to have a very attractive idea in that market. Number two, you also will be very careful about the weight that you assign to that market.
Okay.
So if you go into a bigger market, such as Brazil, like, which is, very large economy, not very fragile, I wouldn't mind having, 20% or 15% of the assets in Brazil. However, let's say if I were to go into like Namibia, I'd never have 25% of the fund's money invested in Namibia, just because that country is a lot more fragile than Brazil. So you have to be, no matter how great the opportunity is, you have to be cognizant of the fact that there might be something happening which is so huge that it upends even the best businesses in the country, right? So with that, like, we would just have a much lower weight in a country like that.
Where do you get your ideas from? Do you use screener services or tips from fellow investors?
We actually used to use screeners early on, and then what I discovered is that the screeners only capture the quantitative aspect of things, and when it comes to the way we invest, it's much more about the intangible part, which is, does the business have a competitive advantage? How is the management team? And what I just told you about Kaspi, they're just never going to show up in a screener. So with a screener, basically, you're going to just get a bunch of low PE stuff, but it's not necessarily going to be great in terms of quality. So we kind of gave up on screeners, and instead we basically pull out a book on a specific region or country, and we go one by one from A to Z and try to identify the names that are of interest from a quality perspective, whether they are cheap or not cheap. And of course, then you try to analyze it. And if it's not cheap, that's most of the times, then you just plug it into the database and you just track it. And at some point, maybe 5 years down the road, or maybe 10 years down the road, you might get a chance to buy it. But at least by then you will have done your homework, and you can make a decision quickly.
Any questions you would like to know? Yes, you would? Okay.
Pavel, thank you very much. One question about geopolitical risk. Can you tell us something about lessons learned from Russia and things should be monitored in China?
I think it's probably too early to draw any conclusions about the Russian case, because I don't think that has played out yet. I think the assets, I'm saying frozen, but they're only frozen for people in the West. If you're a Brazilian owning Russian stocks, or an Indian or the Chinese, like, you can trade those stocks, you can sell those stocks, no problem. And I think those people, if they bought those stocks back during the start at the start of the war, they probably made good money. But I think the conclusion overall would be to say that you have to assign certain weight, and you just cannot assign too much weight to countries outside of your geopolitical bloc. So for us, obviously, we live in the West, so you just have to go a little less heavy on those markets, and you have to diversify a bit more. But again, back to Russia, that hasn't played out yet, so we can't really sell anything, like if we're Western investors, right? But at some point, who knows, if there is a conclusion of hostilities tomorrow and things are back to normal, well, then maybe people are going to come up with different conclusions with respect to what happened to the Russian equities.
Yes, please.
The second part
yes, please. Yes, bring the microphone.
The second part was things you should be monitoring in China?
In China, yes, you should be monitoring China. And I think you just have to have a general view of how Chinese are conducting their affairs versus the Russians, and perhaps how the West is likely to respond. So you have to make somewhat of a judgment. So I'd say with China, in my experience in studying the history of China, they normally do not behave in the same manner as the Russians. Their approach is normally to just kind of just bide their time and just wait and get what they need without having to get involved in a fight. So I'd say, less likely we're going to have China doing something drastic. That's one. Number two, with Western response, same thing. China is so much more important to the West than Russia. So therefore, it is likely that you're going to want to have an open confrontation with China as well. So again, like I'm not saying zero probability, I'm just saying the probability is somewhat lower, and therefore, you have to be cognizant of it, but we're probably going to be a little less shy about investing in China versus investing in Russia, because the very reason we never invested in Russia in a major way in the past is because we had a bit of a concern with the fact that Russia is so much weaker than the West in every sense of this word, and that normally invites conflict. So we thought there was a chance something was going to happen, and that's how it played out. So we never had significant amounts of money invested there. But again, like I said, that case hasn't played out yet. So if the Russian market reopens for Western investors to sell in a year, then perhaps it hasn't worked out all that badly for people who invested there.
Mm-hmm. The previous questioner mentioned that you manage a rather concentrated portfolio.
Right.
How many companies is your portfolio comprised of?
12 companies.
12 companies. And in terms of weight, what's the how much weight you placed on your top 5 positions?
Probably 65%.
65. That's fairly concentrated, yes. All right, so can we wrap up? Call it a night? Yes, no more questions? All right, thank you very much, Pavel, for your time here. It's always very interesting to listen to you and to discuss with you about investing. And next time you're in Madrid, let us know, and we'll have another event here with you.
Sure, thank you. Great, thanks for having me.
It was a pleasure. My pleasure. Well, thank you for coming here tonight, and thank you all for watching from home. And we hope you liked it. Tomorrow we'll be back with another regular event, this time in Spanish. Superacciones con Jordi Martret de Nors Patrimonia. Hasta mañana.